Let me ask you something. If someone sat you down at 20 years old and said, here, this is exactly how to build real, lasting wealth, do you think you would have listened? Most people say yes. But honestly, most people don't. And I know this because I was one of them. I had the drive. I had the ambition. I even had a little bit of money saved up. But what I didn't have was a strategy. A real one. Not the put money in a savings account and hope for the best kind. I mean an actual, intentional, wealth-building strategy. And today, I'm going to give you exactly what I wish someone had given me back then. This isn't theory. This isn't fluff. This is the investing strategy, broken down step by step, that I would go back and hand to my 20-year-old self if I could. And if you're older than 20 right now, don't worry, because the second best time to start is today. Let's get into it. Before I give you the strategy, I need to talk about why most people, even smart, hardworking people, never actually build wealth. And it's not because they don't earn enough money. It's not because they're bad with numbers. It's not even because they don't try. It's because nobody ever taught them the rules of the game. Think about it. We spend years in school learning algebra, history, literature, but not one class on how compound interest works. Not one lesson on what an index fund is. Not one conversation about why the richest people in the world invest their money while the rest of us save ours. And that gap, that knowledge gap, is exactly why the rich keep getting richer and everyone else stays stuck. Here's the thing about wealth, it follows a blueprint. And once you understand the blueprint, everything changes. So let me walk you through the 5 pillars of the investing strategy one wish I'd started at 20. Each one builds on the last. And together, they create a financial foundation that can literally change the trajectory of your life. Pillar number 1. And I cannot stress this enough. Pay yourself first. Now I know that sounds simple. Maybe even too simple. But here's why most people never actually do it. Most people earn money, pay their bills, spend what's left, and then try to save whatever remains. And what remains? Usually nothing. That's backwards. The strategy one wish I'd learned at 20 flips that completely. Before you pay your rent, before you buy groceries, before you touch a single dollar for personal spending, you pay yourself first. You take a percentage off the top and you put it to work. Now, what percentage? A good starting point is 20%. But if that feels impossible right now, start with 10%. Even 5%. The number matters less than the habit. Because here's the truth. You will always find a way to live on what's left. Human beings are incredibly adaptable. But you will never build wealth from what's left over after everything else is paid. Automate it. Set up an automatic transfer on payday so the money moves before you even see it. Out of sight, out of temptation. That one shift, paying yourself first, is the foundation everything else is built on. Pillar 2 is understanding what is genuinely one of the most powerful forces in personal finance. Compound interest. Albert Einstein reportedly called it the 8th wonder of the world. And whether or not he actually said that, the math absolutely backs it up. Here's how it works. You invest $1,000. It earns a return, let's say 10% annually, which is close to the historical average of the stock market. That's $100 in year 1. Now you have $1,100. Next year, that $1,100 earns 10%. That's $110. Now you have $1,210. The year after, $1,331. You didn't add a single extra dollar. But your money is growing because you're earning returns on your returns. That's compounding. Now here's where it gets really interesting, and why starting young is such an unfair advantage. If you invest $200 a month starting at age 20, by the time you're 60, you could have over $1 million, assuming that historical average return. $200 a month. That's less than most people spend on eating out. But if you wait until you're 30 to start that same $200 a month, you could end up with roughly half of that by 60. Same contribution, same return, a decade's difference. That's the cost of waiting. Time is the ingredient that makes compound interest magical. And it's the one thing you can never get back. Pillar 3. This one is where I see the most confusion, and honestly the most fear. People think investing means picking the right stocks, watching the market every day, knowing exactly when to buy and when to sell. And because that sounds complicated and risky, they just don't do it. But here's what I wish someone had told me at 20. You don't need to pick stocks. You need index funds. Asterisk asterisk. An index fund is essentially a basket that holds a little piece of hundreds, sometimes thousands, of companies all at once. When you invest in an index fund that tracks the S&P 500, for example, you're investing in 500 of the largest companies in the United States in one single move. Apple, Microsoft, Amazon, Google, Johnson & Johnson, all of them. One fund. Why does this matter? Because it solves two of the biggest investing problems at once. First, diversification. If one company tanks, it barely affects your overall portfolio because you own tiny pieces of hundreds of others. Second, simplicity. You don't need to research individual companies. You don't need to time the market. You just invest consistently and let the market do what it has historically always done, grow over time. And here's the stat that should settle it for you. Over any given 20-year period in history, the S&P 500 has never produced a negative return. Never. Now, past performance doesn't guarantee future results, and I always want to be transparent about that. But that historical track record is hard to ignore. Index funds also tend to have low fees, which matters more than most people realize. High fees are a silent wealth killer. They eat into your returns year after year without you even noticing. Start with a low-cost index fund. Keep it simple. Stay consistent. That's the move. Pillar 4 is the one that genuinely makes me wish I could go back in time. Because this one is about keeping more of what you earn. And it comes down to one thing: using the right accounts. Most people just invest through a regular brokerage account and pay taxes on their gains every single year. But there are accounts specifically designed to either reduce or completely eliminate that tax burden. And not taking advantage of them is leaving serious money on the table. Let me break down the big ones, simply. A 401k. If your employer offers one, especially with a match, that match is essentially free money. If your employer matches 3% of your contributions, and you're not contributing at least 3%, you are literally turning down free money. That's the first place to start. A Roth IRA is next. You contribute money that's already been taxed, so when you withdraw it in retirement, it's completely tax-free. All those years of compound growth? Tax-free. If you're in your 20s or 30s, a Roth IRA is one of the most powerful tools available to you. The beauty of these accounts isn't just the tax savings, it's that the tax savings supercharge your compound growth. You're not losing a chunk of your returns to taxes every year. Every dollar stays invested and keeps compounding. Max out your tax-advantaged accounts before you invest anywhere else. It's not glamorous advice, but it's the advice that quietly builds millionaires. And here we are at Pillar 5, the one that ties everything together. Invest consistently. Not perfectly. This is where so many people get stuck. They wait for the perfect moment. They want to invest when the market is at its lowest. They watch the news and get scared. They wait and wait and wait. And meanwhile, their money sits in a savings account earning almost nothing. Here's the truth about timing the market. Even professional fund managers, people who do this full-time with teams of analysts and billions of dollars, consistently fail to time the market reliably. If they can't do it, the idea that any of us will catch the perfect moment is a fantasy. What works instead is something called dollar cost averaging. Dollar cost averaging simply means you invest a fixed amount at regular intervals, say, $200 every month, regardless of what the market is doing. When prices are high, your $200 buys fewer shares. When prices are low, your $200 buys more. Over time, your average cost per share evens out, and you remove the emotional, fear-driven decision-making that causes most investors to lose money. The market will go up. The market will go down. There will be crashes. There will be corrections. There will be moments that feel terrifying. But history has shown, repeatedly, that the market recovers, and those who stay invested through the dips are the ones who come out ahead. Consistency beats perfection, every single time. So let's bring this all together. The investing strategy, one wish I'd started at 20, isn't complicated. It doesn't require a finance degree. It doesn't require a lot of money to start. What it requires is intention, consistency, and the willingness to start before you feel ready. Pillar 1, pay yourself first, before anything else. Pillar 2, let compound interest do the heavy lifting. Time is your greatest asset. Pillar 3, invest in low-cost index funds. Simple, diversified, proven. Pillar 4, use tax-advantaged accounts. Keep more of what you grow. Pillar 5, invest consistently, not perfectly. Dollar cost average your way to wealth. Whether you're 20, 30, 40 or beyond, this framework works. The earlier you start, the more powerful it becomes. But the worst thing you can do is wait another year telling yourself you'll start when things calm down, when you earn more, when the market looks better. The best time to plant a tree was 20 years ago. The second best time is right now. That's it for today's video. And if this gave you even one thing to think differently about, I want to know. Drop a comment below and tell me, what's the one investing step you're committing to starting this week? I read every single one. If you found this valuable, please give this video a thumbs up. It genuinely helps more people find this channel and start their own wealth journey. And if you're new here and you want more honest, practical content on building wealth and investing smarter, hit that subscribe button and join the Josephine Invest community. We're just getting started. Next week, we're talking about the money mistakes that are quietly keeping people broke. And trust me, some of them are going to surprise you. I'm Josephine, and I'll see you in the next one. Greenheart.